On Business Incorporated today. The Central Bank of Nigeria unveils rice pyramids in the Federal Capital Territory, Abuja. And Nigeria works to improve trade with South Africa. Fuel shortages persist in Uganda. It's another day for Business Incorporated on Channels Television. You're welcome. I'm Ini John Mekwa. As usual, we'll start with markets on the African continent, and most of them traded negative at intraday. Only the NGX of Nigeria was above the claw backup after closing in the red yesterday. GSE of South Africa shed a massive 1.14%, losing the 75,000 points level. EGX 30 of Egypt followed this negative sentiment, losing 0.39%. Meanwhile, Kenya's share index closed yesterday's session down 0.37%. In the Middle East, major markets were mostly positive. That's the flip side at intraday. Abu Dhabi gained almost 1%, 0.75%, while Dubai was the lone loser. It shed 0.08%. In other regions we track, Saudi Arabia recorded over 0.5% gain at intraday, while Qatar gained much more at 0.80%. We move to Europe now, where stocks were lower today as global investors remain attuned to the policy direction of the United Nations Federal Reserve and the start of corporate earnings season. We have Rob Watts joining us from Berlin now to give us details from the market in the region and, of course, other stories. Hello, Rob. Well, we see that France and Germany have shown that they have different visions of the EU's economic future. What has happened?
So Germany's new finance minister, Christian Lindner, from the economically liberal Free Democrat Party, has been meeting his Eurozone counterparts in Brussels. And he's made it quite clear to them that he wants to see the countries that use the euro continue to abide by strict rules on their spending. That includes a rule that government debt should never exceed 60% of a nation's annual GDP. It's a rule that helped the Eurozone through the sovereign debt crisis a decade ago. However, that places him and Germany at odds with their equally powerful neighbour, France, which has joined other nations like Italy, Spain, Belgium and Greece in allowing their debt to increase to above that 60%. In fact, in some of those cases, it's above 100% of GDP. So where Germany feels it's clearly important to reduce debt, France says the focus should instead be on promoting economic growth, particularly in the wake of the pandemic slump and with the spending that's also required to meet climate targets. So these completely opposing views from Europe's two big powers will shape the debate on this ahead of a crucial meeting that's coming up in March.
Yeah, we hope at the meeting that they're able to meet somewhere in the middle for the good of the Eurozone. Well, Europeans apparently want laws to force car makers to produce cleaner cars. What have they been saying about this?
So this follows a survey of 8,000 Europeans by Green campaigners Transport and Environment. What they found was that 3/4 of people in Europe are in favour of car makers being legally obliged to reduce the emissions of their cars by as much as feasibly possible. Clearly, the feasibly possible bit is key there. What's more, though, around 2/3 of the people they asked said they'd be willing to pay an extra €500 for a car that had lower emissions. So why does this survey matter, you might be asking? Well, it comes just as the European Union is formulating a new set of laws on car emissions. The so-called Euro 7 rules are going to set legal standards for millions of cars sold in Europe from 2025. And that could involve legally compelling car makers to do more to reduce their emissions of their petrol and diesel products in particular. For their part, car makers say they question the idea of this. They say that the amount of spending required to do that, just to squeeze out the final small percentage of pollutants, is out of proportion, particularly when the transition to electric vehicles is already well underway.
And European markets rose on Monday, even though this morning it traded lower. Could you bring us up to speed about how the market closed yesterday?
Yes, indexes in London, Paris and Frankfurt all ended Monday higher. One of the big factors that's being attributed to is optimism surrounding the Omicron variant of coronavirus. It's now the dominant variant in the UK, France and Germany, and it's been driving record case numbers in all three. But all the evidence does seem to point to it causing a milder form of COVID-19 than previous variants, and that's also causing further optimism that coronavirus could in fact be in its end game and it's reaching the endemic phase where it's permanently circulating within the population but at a level where it's not doing enormous harm. That's giving investors confidence that economies are going to recover strongly this year. Optimism on the markets was also drawn from China's GDP figures, which showed that growth slowed dramatically during 2021, but the Q4 figure was not quite as bad as analysts had been expecting.
Thank you so much, Rob, for that update. We'll do it again tomorrow. Enjoy the rest of your day. And so we move to the UK now. The number of company insolvencies in England and Wales jumped by a third compared to pre-pandemic levels last month. Well, is this just about COVID or are there other factors? We have Juliana joining us from our London studios now. Hi, Juliana. Good afternoon.
Good afternoon, Inni.
So UK insolvencies 33% above pre-pandemic levels in December. Is this just about COVID?
Gosh, there appear to be so many different factors involved here. There were 1,486 voluntary insolvencies in December. This is actually lower than the previous month by about 100, but it's still a high number, as you said, 30% higher than pre-pandemic levels of December 2019 and 20% higher than 2020. I think it's lots of directors seemingly feel that their businesses are just unfit for purpose because of COVID. But there are other issues, as I said, lots to do with supply chain issues. We know that inflation is a major topic of concern. It is a lot more difficult and more expensive to run a business. As we discuss extensively in a Brexit bureaucracy is also causing a huge headache for business owners. But I think it's got to be COVID, hasn't it? Particularly in December. We know December was a very difficult month, especially because at this time we didn't really know whether or not the surging Omicron cases would lead to rising hospitalizations as it was with previous variants like the Delta. Hospitality businesses really suffered. 40 to 60% of revenues were lost during that time. Some businesses were losing 10 to 20,000 pounds per week. The number of people coming into shops was also down. And then, of course, we had that mandate from Prime Minister Boris Johnson urging people to work from home. So there were so many different issues, but I think COVID is what has been in the dust for these businesses, sadly.
And even in the face of this, we had a bit of good news about the job data, even though inflation seems to be, making it not looking so good.
Yeah, absolutely. There are currently over 1 million, in fact, 1.22 million vacancies, which is absolutely, alarming in this country. Employers are struggling. They're really struggling to find people to fill vacancies, mainly at the top end, though even hospitality venues are struggling to get chefs and waitress staff in. And so with that, unemployment has fallen because more people are getting into jobs. I believe there were 184,000 people added onto the payroll in the month of December, which is on the whole a good thing. The problem is wages are not rising as fast as inflation. We're going to get inflation data from the Office for National Statistics tomorrow morning, which we'll discuss on the show. But I believe wages are rising at about 4.5%, inflation running at 5.1%. It's getting a lot more expensive to cook dinner, to heat your home. It isn't looking great. So there are major concerns for employers because they know that if they want to keep an employee, they're going to have to pay more. But it's even difficult to find an employee anyway. So that's not it's not looking as rosy as the picture may appear. Lots of filter in it.
Yeah, well, obviously. And are the markets reacting to all of this yet?
Yeah, the markets are not looking great. Besides the fact that oil prices are rising high, so the big oil titans, Royal Dutch Shell, BP, they're trading higher, but the market's in the red. It's in the red at intraday. The all shares down 0.80%. The FTSE 100 is down by 0.71%, and the FTSE 250 that's down by over 1%. In the currencies market, the British pound is also down on the US dollar by 0.26%, also down on the euro by 0.06%, and down yet again on the Japanese yen by 0.13%, Innie.
All right. Thank you so much, Juliana. Always on hand to bring us up to date. We'll certainly talk about the inflation figures tomorrow morning. Thank you so much. Enjoy the rest of your day.
Thank you.
Let's move to Asia now, where markets lost momentum today as major indexes across the region erased earlier gains. Well, oil prices, as Juliana mentioned, trended higher. Chinese mainland shares also advanced. The session followed a quiet day on Wall Street yesterday. The market was closed. Remember, it was Martin Luther King Jr. Day. And in Japan, the benchmark Nikkei 225 fell 0.27% to over 28,000, and the Topix index was down 0.42% to just about 2,000. Japan's central bank left its short-term interest rate target unchanged at 0.1% in line with market expectations, and said it will purchase a necessary amount of Japanese government bonds, such as the 10-year JGB yields that will remain around 0%. The Bank of Japan also raised its near-term inflation expectations for the fiscal year starting in April. Inflation forecast was raised from an early estimated of 0.9% to 1.1% for the fiscal year of 2023. Inflation expectation was raised from 1% to 1.1%. Still, those figures remain below the central bank's inflation target of 2%. And Hong Kong's Hang Seng Index lost almost 0.5% to 24,000, while the tech-focused Hang Seng Index dropped almost 0.5% also to almost 6,000. Australia's ASP 200 fell 0.11% to 7,408 as the heavily weighted financial sub-index faltered 0.29%. South Korea's Kospi index dropped almost 1% to 2,864, and the Nasdaq declined 1.46% to just about 1,000. Chinese mainland shares bucked a broadly downward trend. The Shanghai Composite rose 0.8% to 3,569, while the Shenzhen Component added 0.19%. Let's go to Wall Street now, where U.S. stock futures fell early today as traders braced for the latest batch of corporate earnings report. Futures tied to the Dow Jones Industrial Average slipped by 210 points, while S&P 500 futures fell more than 1%. Nasdaq 100 futures declined almost 2%. And remember, U.S. markets, of course, was closed yesterday. The shortened trading week will feature quarterly reports from 35 companies in the S&P 500, including the Bank of America, United Health, and Netflix. Goldman Sachs is also set to post its most recent quarterly features today before the end of today. Major markets, Wells Fargo, JP Morgan Chase, and Citigroup kicked off the earnings season on Friday, with the three companies posting better than expected profits. However, the market's reaction to those results were mixed. Wells Fargo shares posted a gain on the back of those results, but JP Morgan Chase and Citigroup slid. The Dow, S&P 500, and Nasdaq Composites are all down for the year amid concerns over the recent inflationary surge and the prospect of tighter monetary policy from the Federal Reserve. And yes, talking about oil prices now, the United Arab Emirates has vowed to retaliate against Houthi militants for a deadly attack on its capital, Abu Dhabi, that killed 3 people as fresh tensions in the region help push oil prices to their highest level in 7 years. International benchmark Brent crude futures rose over 1% to $87,089 a barrel this morning, while U.S. West Texas Intermediate futures jumped by more than 2% to $85.56 during the early morning deal. Both oil contracts notched their highest level since October 2014 after a subdued trading day on Monday. Markets were closed for a public holiday. Energy analysts have attributed oil's bullish run over recent weeks to signs of tightness in the market and persist worries of a Russian incursion into Ukraine. The rising threat of a further deterioration in the Middle East security climate has provided further support to oil prices. prompting some to forecast a return to triple digits. We'll take a break now. When we come back, we'll head to the African continent. To stay with us is Business Incorporated on Channels Television. You're welcome back. You're still watching Business Incorporated on Channels Television. Now let's go to a commodities market update. And today is a wonderful day for Nigeria because 1 million bags of rice paddy stacked as pyramids in Abuja were unveiled. This is considered to be the biggest of its type in Africa. Well, what changes will this bring to the commodity space in the country? We have Mayowa Ige, analyst with Financial Derivatives Company, joining us to tell us the perspective of FDC. Hello, Mayowa. Good afternoon.
Hello, Ini. Thank you for having me. Good afternoon.
Good to have you. So while we celebrate the 1 million bags of rice, we know that rice is normally stored in silos and not pyramids. So there are some questions, as in we have them in pyramids now. Is this a new way of storage, or how do you see this going from the pyramids?
Well, to be honest, I don't think that the pyramids are a new way of storage. I mean, I think I haven't heard of any other country outside of Nigeria really having rice pyramids as a form of storage. And in actual fact, I do not think that the federal government of Nigeria actually means for the pyramids to be a method of storage. I think that they've just created the pyramids to showcase the achievement of the program, the Anchor's Borage program, and then they will still distribute the rice paddies to the millers very soon. When it comes to storage in itself, I think we should look at top producers like China, Thailand, India. How are they storing their rice produce? And I think that they still use silos, right? And silos, when we look at silos are safer, they're economical, and they actually store rice for a long period of time. So I think that when it comes to the storage of rice, silos are still the way to go.
And the newly released Consumer Price Index, which was released yesterday, reveals that food inflation went up to 17.37% in December from 17.21% in November. Do you see this 1 million bags of rice affecting price? After all, it's supply that's supposed to go to the market.
Well, the whole program, how did it come about in the first place? As far back as 2015, 2017, Nigeria had supply demand gap of about 3 million metric tons of rice. We're spending as high as $1.65 billion on importation of rice, and this led to this drive to boost our local production. And we have actually boosted our local production, even from what we can see with the rice pyramids. We increased our local production to about 5 million metric tons as at 2021. However, this increase in production has not been sufficient to meet our supply-demand gap, and which is why we haven't actually significantly seen the price of rice decline over the years. And there are also other factors that are still involved in the production of rice in Nigeria. We still have an issue of unavailability of rice paddy. We have high cost of production. We have insecurity. There's still climate change, weather conditions, flooding and all affecting rice production. So I think that while this is said that this would actually reduce the price of rice in the coming period of time, and then Nigeria will go into exportation and all, I'm not sure about that. In actual fact, yes, it's a way to go, but there are also factors that still need to be addressed for us to actually attain that self-sufficiency that we hope to attain, and for us and for the price of rice to decline significantly in the country.
I guess from what you have said, it begs the question that our policies looking at, are they wide enough, to consistently produce what we need? And also, do you think that our policies are solely looking at domestic supply?
Well, I think that the policies are a step in the right direction. I mean, we can't be spending as high as $1.65 billion on the importation of rice annually, and we have forex issues, exchange rate issues. It's not sustainable. So this is more self-sufficiency is more sustainable. But I think that for me, I think of the timing, right? Certain things need to be put in place before we start putting other policies, such as increase in importation tariffs, closure of land borders. We need, for us to be able to meet our self-sufficiency, we need to actually meet address all the factors that actually are affecting the production of rice, insecurity and all of those. So while this is a step in the right direction, there's also still the part of monitoring, implementation. There are still things that need to be done for us to achieve, for us to truly get the results that we desire from these policies.
And after the celebration of today now, you know, we see the pyramids and we have all the broadcasts. Where do you see us going from here now? Is it those bags will be distributed? And of course, how do we see this continuing? Obviously, it's not an Abuja project. It should be a Nigeria project. So how do you see us sustaining this and going forward from the pyramids and the celebration of today?
Well, I think that going forward, we'll continue to see an increase in production. But I think there are policies that these policies have been put in place. We have seen an increase, and I think that in the long term, we'll continue to see an increase in policy in the results from these policies. And I don't think that's an Abuja thing alone. There are also other states that have been involved in this production of rice, and they've also been giving results. Even though still we look at the situation of the lake rice and all of that, we haven't seen them in the market for a while. But I think that with the right incentive, the encouragement in other states, we would see other states come into play, and then it would actually boost the production of rice in Nigeria and we'll see a decline in prices. And hopefully we get into the exportation phase of it.
Yeah, Mayo, I certainly believe that with you. I mean, the mention of lake rice brings back memories. There was a time there was no Christmas or December without lake rice. Now we don't seem to hear about it. I guess this will also be a wake-up call to the Lagos state government and other state government. Thank you so much for sharing your thoughts with us this afternoon, Mayo, and enjoy the rest of your day.
You too.
So trade was a major point on the agenda in the meetings between the South African and the Nigerian delegations during the recent state visit by South Africa's President Cyril Ramaphosa. President of the African Association of Political Science, Professor Chris Isike, says that starting with immigration policies, there are a number of priority areas Nigeria must focus on to make the best of relations with South Africa. Speaking to Channels Television, Nigeria's High Commissioner to South Africa, Ambassador Mohammed Manta, says that the priority now is how to harness the opportunities that the African continent's free trade agreement, which both countries are signatory to, can give.
The other gamuts, especially the area that deals with Africa Continental Free Trade Area. This covers a lot of a gamut of businesses which range from agricultural and outputs and agricultural materials. So by and large, we have essentially been able to tailor our entrepreneurs to bring up our agricultural products to the international market.
Nigeria should focus on negotiating a better visa regime for its citizens coming to South Africa to do legitimate business, those coming to for education purposes. Nigeria can negotiate better, for how South Africa sees and treats them. And then also in the spirit of the African Free Trade Continental Agreement, Nigeria should be able to leverage the South African economy and market the same way that South Africa is hoping to achieve, leverage the Nigerian market.
And then we look forward to, of course, more benefits from the trade relations between Nigeria and South Africa. And that's it on the program today. Thank you so much for being a part of it. Let's do this again tomorrow. It was Business Incorporated. I'm Ini John Mekwa.